Right, welcome everyone to our latest Wealth Labs webinar. I'm very excited to invite on Kelsey Phillips, who is one of my power team members, one of our brokers. She's particularly excellent in the field of analytics, market analysis, equity, and she was an ex-trader at Goldman Sachs. She comes from a financial background like myself, having been at Lehman Brothers for a number of years back in the day. So we've got a similar background in the finance world, which we're hoping to help you with that kind of experience on this webinar. Now, key timing for this webinar really was today. We had a Bank of England base rate decision on interest rates, and they decided to hold the rate at 5.25%. There's the big news. It'll be out all across the internet anyway, but it's slightly disappointing, and I think we were all hoping that they might drop it down a 0.25%. Word on the street for the last couple of days was they probably wouldn't, so it wasn't unexpected today. But I'm interested to hear shortly on from Kelsey on her take on that, what that means for the market in terms of the rates holding, how it's going to affect the markets, and how it affects the forecasting and what the likely 12 months ahead is going to look like from an interest rate and monetary policy point of view. We're also going to touch upon the spring budget, which was held recently. There are a number of property related matters there, particularly disappointing, I would say, for property investors and developers alike, and first-time buyers. There wasn't this 99% mortgage that was rumoured to possibly be mentioned or brought up or introduced this time round. From a developers or investors point of view, multiple dwellings relief was also abolished, which is stamp duty saving when buying a number of properties. Of course, there are ways around these things. And for that one, very simply, if you're buying 6 or more properties, you can apply commercial rates. You can still apply commercial rates on commercial conversions and lots of other types of properties. So there's still, there's still ways to minimize your tax and invest sensibly. So it's not all lost. They also brought capital gains down from 28 to 24%, which actually is quite significant. There's quite a few landlords exiting the market, considering exiting at the moment. I think this year we're going to see, a fairly subdued market and quite a few people wanting to exit when they think the time is right. You're going to see some distressed exits, now and over the next 6 months still, from people hurting from the recent interest rate increases. So it's really, in my opinion, still quite a buyer's market, but I think we're definitely coming into the era of things improving, maybe slowly, maybe steadily. How so? We'll find out a bit more from Kelsey in a minute. Hopefully she'll be able to shed some light on that. One of the other big things for property investors is that they've abolished the furnished holiday let regime. And this was where holiday lets could be treated on more of a sort of commercial basis. You could offset your mortgage interest against cost, which you can't do now after Section 24 was introduced a number of years ago against your mortgage. So that's a negative. And they were getting some capital gains benefits as well, which they're now also not getting. So that's something which will disrupt operators in that section of the market. Thankfully, I'm not in that sector, but I know many people that are, and a lot of my clients that I mentor are. So, lots of changes afoot. It's going to be an interesting year. It's going to be a relatively slow year, I think. How slow? I just don't know. There you go. That was a nice rhyme, wasn't it? Couldn't resist it. But I think next year is going to be a bit of a stonker, and I think we're going to see some sustained growth. I think there's a lot of pent-up demand. There's a lot of people wanting to do deals. There's a lot of people with capital that's been pent up and not spent, both from foreign investors and across the board in the UK. People are holding on to their money when they've got it and just waiting to pounce on the right deals. So, yeah, it's an interesting time, and I'm looking forward to getting into the deep dive. So, Kelsey, welcome to the latest webinar with Wealth Labs. How are you?
Very well, thank you. Yeah, delighted to be here today.
Awesome. Thank you for joining. Just to kick us off, what's your take overall on the spring budget? I've just sort of waffled on for God knows how many minutes, but I'm keen to hear your opinion and how it relates to your part of the world and property finance and all that sort of stuff.
Yeah, absolutely. So to jump straight into the UK spring budget, obviously I'm sure all of us have seen the headlines, we've seen the policies. I think it'd be probably a little bit boring for me to kind of rattle off what those policies are. In my opinion, government policy serves as a form of incentive structure in that it motivates economic behaviour. If you're well positioned within an economy, you'll prosper. If you're swimming upstream against policy incentives, you'll certainly know about it. So now, with respect to the latest spring budget presented by Jeremy Hunt on the 6th of March, I would like to discuss how, I think it's more interesting to say, as I've said, what's the government trying to incentivise? I'd be interested to know your thoughts, Nick. Anyone here? Let's use the chat box and see kind of what your thoughts are. It seemed apparent to me that the UK government is making business more difficult for what I would term the amateur landlords. So by amateur landlords, I'm talking about the middle glut of portfolio investors, perhaps with less than 15 properties. They're not incorporated, they're owned in your personal name. The step before, perhaps it's been a massive corporation with tens and tens of properties. So to substantiate that claim a little bit more, okay, UK government, are they making it more difficult for amateur landlords? Certainly, if you are an amateur landlord, by my description, you may feel that already. I would highlight a couple of key attributes from the spring budget. So first and foremost, the most widely discussed property policies pertain to the holiday let market. So buy-to-let investors on this call will be well aware that you can claim mortgage interest as a tax reducer write-off. That's 20% of the mortgage interest against your taxable income. So that was true of all residential property investments except for furnished holiday lets, which until now were treated much like a business. You could write up to your higher rate tax bracket off of that mortgage interest, 40%. Well, as of April 2025, that will no longer be possible. The policy is being abolished and furnished holiday lets will be treated much the same as standard buy-to-lets. Now, if any of you are sitting here today as FHL landlords, as they term them, and particularly if you're dependent on that interest write-off for the cash flow of your investment, you'll be well aware that the government is incentivising you to make one of two choices. Either you exit that market or you double down and transfer your portfolio into a limited company infrastructure where you could write off 100% of your mortgage interest and retain the profits within that corporate structure at the 25% tax rate for corporations. If you do nothing, your net monthly cash flow will undoubtedly be penalised. So we're kind of pressed into a position here. Do I just exit the market or do I enhance my cash flow by incorporating the portfolio? I think the second key...
Jump in there, Kelsey. It's basically what normal buy-to-let lenders, landlords had to do when Section 24 came in, isn't it? It's almost like they've just been sucked into the Section 24, which is really horrible. And we know we were all very fearful of that at the time. It's a tricky situation for them now.
Precisely that, and they're clamping down more and more on different aspects of the property market. So the second key attribute I would use from the spring budget to highlight how amateur investors are being incentivised would be with, as you said, Nick, the multiple dwelling stamp duty relief that's being abolished. So whilst the multiple dwelling relief is being abolished, the commercial stamp duty relief will remain. So what does that mean for us? Well, as of now, where two or more residences are purchased within the same transaction, let's say for an aggregate of £400,000, multiple dwellings relief would allow you to calculate your stamp duty obligation as if it were two purchases of £200,000. Given the stepwise nature of stamp duty relief, that could be preferential for portfolio purchasers. Now, unfortunately, that stamp duty relief will no longer persist for purchases after the 1st of June this year. However, if you're purchasing 6 or more properties, the existing tax relief will still be applicable. So again, stepping back out, from a tax relief perspective, larger portfolio purchases are being incentivised. If you're a portfolio property investor, the government is incentivising you to take one of two choices. Either you scale your property business to breach into that upper threshold, or you downsize and dispose of your assets entirely. And if you decide to do that, you decide, right, actually, I'm just going to exit the market, the government has made terms for you to do so more preferential by reducing the capital tax payable, specifically on properties, from 28% to 24%. So I guess in answer to your original question, rather than just rattling off the kind of different policies that have been announced, my initial thoughts on the UK spring budget is that the UK government has revealed its cards, really. We can't really define the rules of their game, but we can learn how to position ourselves optimally to monetize the government's incentive structures.
Lots to take in there, obviously. I'm keen to see some graphs and some geeky forecasts, which gets me very excited when you talk to me, Kelsey. I'm one of those sad people that comes from the finance world and likes to see forecasts. But so can we get on to the meat of some of your talk today and hear a little bit about sort of interest rate predictions and the effects on the market, in terms of the decision today from a finance perspective, and just to really understand, when are we going to get this blooming interest rate reduction that we're all hoping for? Because that's the sign that the valuers suddenly go, oh, the market's going in the right direction. We're not at the top of the hill still. We're on the downward hill, or the other way. We're at the bottom of the hill and we're on the up again. And that first point, that first tick down in the interest rate, for me, is going to change the sentiment dramatically. The sentiment is already, positive. I think this year it's been increasing. It's been okay. But this again, I think, will, keep it subdued for longer, regrettably. I mean, I think when we had a webinar end of Q3, was it last year? We did one, and the predictions were from the market that we'd probably see an interest rate tick down about this time, possibly this decision or in April's decision. So maybe it still comes in April. I don't know. Is it monthly, these decisions?
Not quite, but not far off either. Between 1.5 1 month. Yeah.
Right. Okay.
Yes.
And so I guess, what's the current sentiment then on the street?
Yeah, absolutely. So if you would allow me perhaps 2-3 minutes just to maybe contextualize the market that we're in while we're in this position, what is the government trying to achieve, and then kind of go through today's decision and how that leaves the interest rate expectations and then mortgage market, kind of lead us around the houses, excusing the pun. So I think so I think first and foremost, to describe our current macroeconomic environment, I think it's important to contextualize the economic circumstance. So following a period of COVID lockdowns commencing March 2020, the UK government embarked on a period of significant monetary stimulus packages. Now, official figures are still slightly vague about how much COVID actually cost us, but in September 2023, the House of Commons gave a figure of between 300 to 410 billion pounds. And those funds were deployed into our economic system effectively via taxable grants for self-employed people, business income support schemes, and furlough for the employed. Now, the consequence of that mass quantitative easing was twofold. Firstly, the UK government debt grew significantly. As of February 2024, our public debt sat at £2.6 trillion, relative to our annual revenue as a country of £1 trillion. So we have a massive deficit. Secondly, the second core consequence of COVID is that consumers, you and I, in the UK, found that we had significantly more net real disposable income than before. And that was mostly a consequence of lockdowns. If you were fortunate enough to still be earning, you couldn't really spend your money. There was nowhere to spend it. No. So instead, we saw some initial panic buying of kind of irrational purchases. And then over time, it channeled our consumer spending habits into certain avenues. So you saw, service-related revenues were up massively. Amazon profits were up massively. Netflix, all these consumer goods and services grew massively during that period. Now, in terms of physical goods, we saw that channeled spending behaviour exacerbate structural supply deficits. In my view, those supply chain deficits were already there. You know, we were still kind of post-Brexit negotiations of trade. You know, they were also emboldened, those supply chain deficits were also emboldened by escalations to tensions in the Middle East, in Eastern Europe too, to the extent that both of those wars threatened to disrupt food and energy supply chains. So, and you would feel that at the time, you know, you go into the food shop and everyone was complaining, or the prices are going up monthly, you could feel it. And petrol at the time, everyone was saying, can't believe how much this has cost me to fill up my car. And that's all as a result of these structural supply deficits that I'm discussing. And it was cost push inflation drove UK consumer prices up to a high of 11.1%. That was in October 2022. That's a meaningful problem for the UK government, because unless wage growth can sustain those price increases, pretty quickly economic activity halts. People can't afford to supplement their lifestyles and potentially even necessary goods and services. So faced with that circumstance, what can the government do to solve for the COVID-derived inflation crisis? Now, you mentioned our webinar in Q3 last year. I believe it was November last year. And we discussed on there the kind of two main levers that the government can use: fiscal policy, being taxation and government expenditure. And the second lever is monetary policy, effectively controlling the money supply via debt markets and the Bank of England base rates. So slowly but surely, I'm guiding us, that's the kind of context, guiding us to our present day economic circumstance. Well, the Bank of England chose the lever to control inflation of monetary policy. So using the Bank of England base rate to incentivise savings, disincentivise borrowing by raising the Bank of England base rate. Now, consequently, during the period between December 2021 and August 2023, there were 14 consecutive Bank of England base rate hikes, up from 0.25% to 5.25%. Since then, the Bank of England has conducted 5 consecutive base rate holds, including today. And we have seen during that same period, CPI, Consumer Price Index, it's our main measure of consumer goods and service prices, has fallen from the high of 11.1% to yesterday's print of 3.4%. Now, it wouldn't be a full picture if I didn't just briefly mention, we're also teetering on the edge of a second technical recession. So technical recession is negative GDP for 2 consecutive periods. So we've had one in January and we're waiting for that further data. Now, my thoughts back in November, in our November webinar, is that really we were pivoting from a rate risk environment into a regulatory risk environment. And I won't mention it, but here are just a few of the things that we've seen since then. So just to verbalize them, we've seen an EPC requirement U-turn, we've seen a reduction in tax-free capital gains allowance, the multiple dwellings relief abolition, we have a general election upcoming at some point before January this year, 2025, sorry. The rent reform bill continues to go through, the stamp duty threshold increases again on the 31st of March 2025. That was a policy that Kwasi Kwarteng introduced. So bringing us right to the present, which is the Bank of England monetary policy decision today. Again, it was a decision to hold at 5.25%. And your question was kind of, what were my thoughts on it? How has the market reacted? Was it expected? I think an interesting way to answer the question would be to hold ourselves accountable to that November 2023 model. So I think at the time we said, let's remember to hold ourselves and mark ourselves to market. So Blue Peter moment. Here's what I prepared earlier. Here are, as of the 20th of November, the base rate modelling that we shared with people on a similar webinar. Now, for those of you that may have been on that call, just very briefly, in my trading days, in order to kind of manage my portfolio, I had to run interest rate model expectations. And now that I run my own property finance business, interest rates are arguably the single largest risk that property portfolio investors have to manage. And I still run those same interest rate expectations for my clients. So to explain, these are not my expectations of what the market will do. This is what is implied from the GBP swap curves, what the traders who look at this for 15 hours per day, what do they expect to happen to interest rates? As
Kelsey,
of the 20th,
I don't know if you, I can't see a thing on the graph. Yeah, okay. It's coming on, is it? I didn't know if it was
coming. Yeah, I'm glad you said. Yeah, just better off checking.
There's a block thing on the right. I'm not sure it matters, but there's something sort of covering the right screen.
Let me try and hide that. Is that better? That was the Zoom call.
Weird thing that's on your screen. Doesn't matter. It's irrelevant. You can see. Oh yeah, there you go. It's better.
Okay. So yes, now as of the 20th of November, this is the graph that I would have shown you. So on the horizontal axis, you can see its monetary policy decision dates of the Bank of England. On the vertical axis, it is the implied base rate. Again, this is implied from the swap curves. It's what traders are expecting, where traders are expecting the base rate to realise. And you can see over time how the swap curve decreases. They're expecting generally rates to fall. Now, referring to these expectations and perhaps just to interpret what the graph says, the market was pricing in 100% of a 0.25% cut prior to the 20th of June monetary policy decision date. And you can see towards the right-hand side of the curve, they were pricing in some probability of a second cut through the second half of 2024. At that point in time, on the 20th of November, 36% of market participants expected a 0.25% base rate cut on today's monetary policy meeting. So you see, actually, the meeting was held yesterday and the notes were released today. So the 20th of March, 5.16, that's a 36% probability of a 0.25% cut. Now, I'm sure as you will have all seen today, the Bank of England decided by a majority of 8 votes to 1 to maintain a base rate of 5.25%. One member preferred to reduce the base rate by 0.25%.
Good for them.
Exactly. One lone soldier.
One loner. Who are they?
I know. Friends of us, I think. Yeah. But he was obviously outvoted. Now, as I said earlier, it's the 5th consecutive hold of the base rate following 14 consecutive hikes. And I would say the majority market expecting another hold today, particularly on the back of the US Federal Reserve hold yesterday, and then signalling potentially 3 cuts through the end of this year. So in answer to your question, how have the markets since reacted following the very recent base rate hold? Well, hot off the press, here is the latest graph. At the front end of the curve, you can actually see expectations are broadly unchanged. The market continues to price in 100% of a 0.25% cut ahead of the middle of this year. Now it's just slightly shifted to the 1st of August. But what we can see, if anything, is that the curve has slightly steepened. So you can see this more by looking at the actual figures, the numbers listed here. In fact, the market is now, as of 40 minutes ago, pricing in 96% of a 0.75% cut before the end of this year. It's like buying a house with planning permission and it almost being fully priced in, which is 4% not priced in. You know, they're basically, I would say, near certain. And you can think of at least, let's say 0.5%, they're absolutely certain. And there's 4% of market participants who aren't sure that there will be 0.75% cut.
Okay, so that's pretty big, isn't it? I mean, that's the biggest bit of information you've hit me with. They're pricing almost certainty of 0.5% drop this year, like that fact.
Yeah,
and what was the percentage for 0.75% drop?
96%.
96%. I mean, that's as close to certain as well, isn't it? I mean, that's a huge drop. So down to 4.5% essentially, or well, here, sorry, down to, yeah, almost 4.5%, isn't it? In reality, that would be by the end of the year. That's amazing. Let's hope that happens.
Exactly that. If they are correct, that would be absolutely excellent for the property market. And I think the rhetoric, you know, UK monetary policy often follows suit from the US Federal Reserve, and they signalled yesterday that they expect, as I said, 3 consecutive cuts before the end of this year. So yes, let's hope
let's hope they do. Sorry, I didn't mean to interrupt. Note to selves: can we bring in the Fed number graphs like this for our next webinar? Because like you just said, the UK, you know, Bank of England is often following what the Fed does in their rate cuts. So to see that, do the timelines on that match up as well? Like, when's the decision in the Fed? The last decision in the Fed, was it the same day yesterday, or?
they're slightly different. So it's yesterday, but typically and rather conveniently, the Bank of England tends to operate on a 1 to 2 day lag to the Fed. So they wait and see what happens, and then probably change their votes in accordance. So absolutely, perhaps next time as well, we can talk a little bit more about kind of the relationship between the two, and how hot money flows between economies and how that can affect the UK property market. But definitely, I'll include expectations next time for the Fed.
Good idea. Okay. Something to look out for next time then, guys. Sorry, carry on, Kelsey. Where were you? So you got me all excited about rate drops. So I was just like, oh, gotta like revel in that excitement that we're going to see some rate drops. So when should I fix my mortgage is the question that everyone's going to be asking. Shall I just hold off and suffer a bit of a high interest rate for another 6 months, or shall I fix everything now, or shall I fix it on a 2-year, or shall I fix it on a 5-year? You know, so different decisions, right, that people have to make in practical terms.
Yeah, so in practical terms, so the mortgage market, I should add, I think I did in our last webinar, but just to communicate fully here, the mortgage market is very much derived off the back of these same curves here. So these curves move dynamically in line with changes in economic data points, whether that's GDP, wage growth, inflation. To that end, escalations in the Middle East and Eastern Europe will and do affect this curve upon which mortgage rates are derived. So many of the changes to interest rate expectations are pretty instantaneously priced into mortgage markets. So over the last 6 months, we had, particularly at the earlier end of the 6 months, there was a very interesting dynamic where the base rate was continuing to rise, but mortgage rates were falling. The reason for that is that inflation expectations were falling, and thereby the speed at which interest rates need to rise to solve for inflation is changing. So we saw the swap curve flattening, at that point in time, and then mortgage rates coming lower. In the past 2 to 3 weeks, we have seen mortgage rates, it's a bit of a mixed bag, but I would say on average, trend marginally higher by about 7 to 8 basis points. So all of this is to say the expectations are largely priced into the mortgage market. So I would say, you know, I have clients, it really depends on, as I was saying before, I think we're pivoting from a rate risk environment to a regulatory risk environment. And when I'm speaking with clients, it's more about, okay, what's your risk appetite? I've got some clients that want to go on 2-year variable rates because they want to benefit as the base rate drops. But those rates kind of entry point are in and around 6.3 to 6.5%. So you're going to need a good 1.5% to 2% drop. And if that's your view, you're thinking that we're going to have considerable drops in the next 2 years, then so be it. There are market solutions for that. Others are preferring the budget certainty, and they see upside risk to inflation for some of those factors that we just discussed. You know, let's say a different party gets into power in the UK, they may have certain policies which could be inflationary, may or may not be. It depends on your speculation. So some of my clients just want certainty, fixing in on 5 years. Particularly those clients are struggling with rent coverage ratios. So ensuring that your rent covers your mortgage interest by a certain ratio, and that ratio itself will vary whether they're owned in your personal name or limited company structures. So 5-year fixed are perfect for that solution. And then 2-year fixed is people who kind of want a bit of certainty, but also want to take a view on the rates market. So in short, most of the rate cuts are already priced into the market, I would say. That's why you can borrow at 4.2% at the moment, below where the Bank of England is lending to other banks. And it just really depends what suits your portfolio best.
And some of that pricing from the banks being lower than the current interest rate is due to the fact they've probably secured those funds before the rate increases. Like they could see the rapid rate increases last year probably coming, right? So they would have filled the coffers with money to lend out at a lower rate before lending it out. Can I ask you a question?
Absolutely.
Do you think the banks will just keep rates reasonably high for a reasonable amount of time anyway, even if the base rate comes down 0.75% by next year? Are the banks just going to hold rates kind of where they're at now anyway? So, you know, I think my misconception previously, and not so much now, was that when the Bank of England base rate comes down, immediately rates start falling. But that's not necessarily the case for the banks, because they might have been, like you say, priced it in already, or they're going to hold out and profiteer from it to some degree, you know, and they'll make their money back over the next couple of years because they priced it low to get everyone in on their 2 to 5 year rates, and now they're going to make their money over the next few years as they don't bring them down much. Is that going to happen, do you think? Because it's great to see the graphs from the Bank of England. It'd be great to see a predicted graph of what the banks are actually going to do. I don't know if that exists. You can get that information, but just if not, then just to be good to hear your opinion.
Yeah, absolutely. I wish I could, as an investor myself, I wish I could see it and have, you know, my own crystal ball of where do I think, you know, mortgage rates are going to realise. I think that base rate is our best estimation. It's upon which mortgage rates are derived. Now, each lender, and I try to, obviously sitting in a unique position of intermediation, I can kind of consult the lenders on their feeling towards market sentiment, and, you know, even with valuations, are they being conservative, or with rates, would they prefer to have more of a risk premium? And I think it really comes down to their own appetite and where they're sourcing their funds from. So you know, just to touch briefly on how banks can you know, lend below the base rates, it really depends, as you say, Nick, on how they're deriving their funds. So some will have preempted into those 14 consecutive base rate hikes. They would have started to borrow wholesale funds at cheaper rates, expecting their cost of funds to rise, such that they can potentially monetize that opportunity set. In the same way, fixing in a 5-year fixed in November 2021 would have been a profitable trade to do. Banks are doing exactly the same thing. They're borrowing cash cheaply, you know, and then hoping to deploy it at elevated levels. Other banks have deposit funds where they can borrow, you know, 3-4%, even 2% in some bank accounts. And so they're raising funds cheaply and being able to deploy it via mortgage markets at 5-6%. And then others are applying the projections, the downward sloping curve that I just showed. So I think the fourth thing that is playing into their modeling of where they're happy to deploy capital is their expectations of volatility in their cost of funds. So to the extent which Rishi Sunak has been so set on from the beginning is restoring stability in our financial services. So obviously, even let's say one day your cost of funds is 5.25%, next day it's, you know, the interbank lending rate drops 2%, and then next day it's up 3%. What happens is, as is sensible business, you start to take a premium in and above your actual cost of funds because you're not sure where it's going to realise amongst that. Now, I think confidence is growing within lenders in the same way. I'm not a lender myself, this is just an opinion piece. It feels that confidence is growing, as it is too with end buyers, with first-time buyers, with investors. There's confidence being restored. I still think there is some hesitation on the back of the regulatory risk that exists through this year. I think some lenders will wait to see what policies are put into place before they really double down. But I think on the whole, there's appetite. And you can see, for example, West One in the buy-to-let market have a rate below 3% at the moment. So that's super aggressive. And, you know, most brokers across the street are saying we can lend at 2.7%. The hidden piece of that is they're charging a 9.99% arrangement fee. So unless you're paying it up front, you're adding 10% to your loan principal, which is extremely costly. So there is appetite to gain market share. You can see that in small pockets of the mortgage market. And I think it just, some lenders are waiting to see what's going to happen.
I think that's a clever product in many ways, right? Because there'll be investors that are being hit from a cash flow point of view with these high interest rates and will welcome a get out of jail free card for the next few years until the market recovers, values recover, and they might be in a position to sell the property. So actually, that's quite a clever product to sort of backload it, you know, as a fee which gets added to the term of the loan. So you're loaning more and you're getting less equity in, but at a lower rate. So the interim, your rent coverage is going to be pretty good. You maybe get some income, some positive income coming in at a time that can be quite tricky for some investors in the market. So yeah, clever product. I mean, there's, like you said, there's all sorts of solutions out there depending on the scenarios of a particular client, isn't there? And
absolutely,
the fees
I'd say it's needed.
Sorry, go on.
Sorry, Nick, a small lag there. Yeah, I was just saying, I think it's needed. It's solved for a problem in the lending space where rent coverage ratios aren't being satisfied. They've dropped the rate significantly, but they've made their premium in another part of the product. In the same way, it appears to me that there is massive demand for holiday let lending. Despite the recent spring budget, holiday let lending is very hard to come by. Equally, I would say in the kind of guaranteed rent space, there is massive demand for lending and just lenders generally.
Have you mean guaranteed rent space in?
So like rent to rent schemes where landlords own a property and then there'll be a corporation that comes in and guarantees rent to them. Lenders are not comfortable with that just because it's all about seizing the asset. If they need to regain that security, it's very difficult to do with a third party, you know, basically leasing it, and then they themselves have an end user in the property. It's very convoluted from a lender's perspective. So they're two pockets I notice when I'm discussing with my clients where there's funding product needed.
Great. Okay. I'm going to open up any questions to our guests that are live with us today. Reinout has got a question. I'm just opening it up, figuring out my tech here. Reinout is based in mainland Europe. Do you see any reason that FX rates, i.e. GBP to EUR, could become more volatile than they have been in the last few years? So is there an effect on FX rates for this? So it's good for a foreign investor looking to invest in the UK. What's the potential risk there for him?
I hope not more volatile, because my goodness, has it been so volatile. Were you not an FX
trader when you were at Goldman Sachs?
I wasn't specifically in the FX team, but I traded a large amount of FX for my own portfolio. And I remember when the autumn budget under Kwasi Kwarteng came in and the pound was just plummeting. I mean, if you're sitting in Europe, it must have been happy days for you. But I remember, yeah, exactly. But I remember just watching my portfolio and just thinking, why? As it was happening, I was watching it on the screen. I was like, why are you doing this? This is totally fiscally unsustainable. So it didn't last long, but that was extremely volatile period there where, and the pound, I remember the pound being well supported at 1-to-1 with the dollar. I would hope not more volatile. I think it's been extremely volatile, but there are certainly circumstances when that could be the case. If we have similar policies announced that the financial markets deemed to be fiscally unsustainable, you know, let's see what happens in the general election. If there's an escalation to any wars in Europe, that could be terrible for the euro. It's kind of like it's hard to predict what could cause that kind of instability. you know, there's also talks about debt levels generally across developed economies being totally unsustainable. Could there be a migration to some form of digital currency? There's white papers on the Bank of England's website about the digital pound and the digital dollar, equally on the Fed Reserve. So if they move away from traditional mediums of exchange, that could cause great volatility. So it is difficult to predict the unknown. In standard course of play, in the absence of any of that, you'd like to think the last few years have been extremely volatile.
And look at crypto's been back and then not back, and then it's going back down again now, and it's it's a bit of a tricky one. But that was a really good question. Thank you, Ryan. Really useful. If you've got any more questions to the floor before we wrap up, Nina, yes, fire away. Do you want to unmute yourself? You're welcome to unmute.
I've unmuted myself. Yeah, thank you very much. I was just wondering about. There seems to be quite a tight gearing on rents now, and rents seem to be escalating up quite nastily. And is this a dangerous situation where landlords are finding it really quite tight and they're having to jack up rents? And yet, is it unrealistic in the market for the way that the rents are getting jacked up, particularly on HMOs and all that sort of thing?
Do you mean rates, as in just rates in general?
I mean the rents that are being charged to tenants.
Yeah, sorry, the rents that are being charged. Yes.
Sorry, rents. RENTS. Yes, sorry. The rents.
That's my fault. I'm not paying attention. I'm not.
Sorry, the rents that are being charged.
Wash my ears out.
To tenants seems to be escalating up quite a lot, and whether this is because landlords are feeling quite pushed with their overheads, not just mortgages and stuff, but service charges and so on. And is this starting to be a dangerous situation? That's all. Thank you.
Yeah, good question. I mean, I'll answer that first, and Kelsey's welcome her view in a moment. I think, you know, what's happened this year is we've had all of the inflation coming off the back of COVID still, and the effects of that from businesses going bust, undersupply, some of the effects of Brexit and foreign workers moving back to Europe. It's affected supply, and building supplies had huge hyperinflation and rapid inflation shortly after the year or two after COVID. All of that pushed into utilities, which inflated again quite rapidly, and it's just been a bit of a tricky situation for property investors, and they've had to turn to rents to get some of their margin back to survive, even not just make money. You know, we are operating on a lower margin now because actually the market will only take so much. You know, you've still got to keep your properties rented. You can't just add on, you know, your inflationary costs and hope that it'll get paid. You've got to wait for the market to pick up, and it does lag. And actually, I think you're right, Nina. The last year to 18 months has seen more of a rise, but actually the inflation for landlords started, you know, the year or two even before that. And then, of course, interest rates last year, that is going to be again pushed straight onto tenants, and so it is very high. What I would say from my experience, we've got roughly just shy of 300 tenants across our portfolio currently. Those tenants are paying the rent, and we are as full as we've ever been. You know, we had to drop rents a little bit in the first year or so of COVID because of lack of movement, and certainly when all the lockdowns were happening, you know, you had a rent loss at that point, not huge, and we were fine. But you know, there wasn't a very clear effect. It took a while to get that back, but now it's firmly back. But it can't go on forever. You're right, and it is a shame. I mean, we saw at one of the last property investor shows at the end of last year, you know, tenant groups that were protesting outside, telling, you know, landlords are bad for putting up their rents and all this sort of stuff. And it's, well, we don't dictate the monetary policy and we don't dictate the markets. We just react to them and survive. You know, we're making a margin at all times, hopefully, sometimes less, a lot less, but not necessarily profiteering off these situations. But they see us putting rents up as we're profiteering. That's not the case. Almost certainly not the case. So yeah, difficult situation. But I think that, you know, what we've seen today from Kelsey is that rates are coming back down. Inflation is well and truly down, and now that lag over the next year or two will start to kick in, and actually the price of goods. I went to Subway, had a Subway for lunch, and for two of us it was 20 quid, 20 euros, I should say, because I'm in Europe at the moment, and that is a lot of money for lunch for a sandwich. It's crazy. So these high costs are still out there in the market. It's going to take a while those costs to come back down as those businesses start to suffer, and they have to start dropping their prices again. So we're now on the back end of this inflationary curve, as far as I can tell, and it's potential that rents will come back down a bit as well as the interest rates come down and the inflation comes back down. The market for rents will come and normalize. It's a free market in many senses, in that we've got to compete with other landlords, and if people start dropping rents because they're starting to get less voids, the whole thing will just realign naturally, I think. I hope that was useful. Anyway, that's my take on things. Kelsey, have you got anything to add on that sort of question of high rents?
Yeah, I think it was a very good way to explain it, Nick. I think I would just say it is a problem, and it's a concern, I guess, to a certain extent with landlords. It's a concern on both sides. Landlords are not making more profit by, if anything, their profit margins have reduced drastically. Their costs have been, most of my clients, 2 to 3 times. But as you're sensing, there is an upper threshold of affordability with tenants. To a large extent in the UK economy, it's self-inflicted. So we released all these stimulus packages. We can't really afford it. We've then had to increase, we've created inflation. We then had to increase interest rates. We've like $2 trillion of our own debt, and then we've increased the interest rate, which devalues our own debt because of the bond markets. So we've very much created a problem for ourselves. Now, one of the things I think that helps us a little bit in England, in Scotland, they've actually introduced rent controls. So can you imagine a scenario where you're remortgaging and you're unable to increase your rents enough to cover the rent coverage required by lenders? You would literally be scuppered and you'd be forced to sell your properties. Here in England, we have some interesting mortgage products, as we say, 2.99%, where lenders are dropping, you have options available to you, and you can increase and change the yield of your property. I think lenders are trying to, and they're incentivized to by the government, work with landlords to find solutions. And not only landlords, but also particularly if it's a primary residence, they have to be, by agreement with the government, more lenient with you. And one of the ways that they've been more lenient is by, typically, if you'd have spoke to me in October 2021, you would have seen the base rate was 0.1%, residential mortgages 1.8 to 2.3%, and then buy-to-let rates perhaps in and around 3.5%. So there was a 1 to 1.5% premium of buy-to-lets over residential mortgages. Well, now what you're seeing is actually buy-to-let rates pretty much in line with residential mortgage rates. But instead what they've done is they've stripped out that 1 to 2% premium and added it to the arrangement fee. The reason why they've done that, I can see you thumbs up, Nina, so you've seen it yourself. The reason why they've done that is because they know, particularly in the south of England, gross rental yields are between 4.5% to 5.5%. So the base rate's at 5.25%. So they know if they were to add that 1 to 2% margin on top, you're looking at, 6.5%, 7%. Most of the cash flows in the south of England would not stack up, and you just see a slew of properties go onto the market. So they are, in short, the lenders are aware of the problem. They're trying to come up with solutions. Hopefully the government comes out with some policies that support the lending market further than what they already have to help us. Hopefully they don't do rent controls. I know that obviously we have a general election coming up. Conservatives have stated they're not in favour of rent controls. Labour too. Lib Dems and the Green Party are in favour of rent controls. So that's just something to keep in the back of your mind. And yeah, I think hopefully the government protects landlord interests in addition to tenant interests, because there are, the rent reform bills going through. There's an obvious support for tenants. I think landlords too need support.
Yeah, really useful. And I think I just wanted to add one more point that's really prudent for the landlords among us, and future landlords. Something that we've seen, and I know we've discussed offline, Kelsey, in this market that we've been in for the last few months, is coming to refinance existing properties. We've struggled on some of ours, which were less than 50% geared, and yet a higher rent than when they were financed 5 years ago, and we're struggling to get the refinance through on say 65% rent commercial loan. The reason for that is valuers. The valuers are applying a higher yield when they're coming to value the properties than they were a year ago and previous to that, because of the interest rate rises, which means the commercial valuation is getting knocked substantially. If you apply a 7% yield versus a 9% yield, you're knocking hundreds of thousands of pounds off a potential valuation. So despite us on paper, having a red book valuation from 5 years ago that says our property's worth 1 million, and we've got rents that are 20% higher than 5 years ago, we're struggling to get a valuation of 800,000 at the moment, because they're adding on a yield of like 9%. Yeah. Nina's a valuer. Nina will know why that's happening.
Well, I gear myself away from doing red book valuations on commercial property because of that very reason. I'm watching my professional indemnity insurance. Be careful.
Exactly.
Yeah, seriously. Because otherwise you get hammered for it, and I think some valuers are not looking at it in a proper light, in the market light. Yeah, thank you.
No, I think and it's good to hear you agree with that. And I think there are valuers out there. We've had some perfectly fine valuations, or we've had to do second valuations, or some of those have been fine. And it comes back to finding pragmatic lenders and valuers. You can pick valuers sometimes, and I encourage you, if anyone's got a valuation coming up, to talk to the valuers early. Make sure you're talking to the lenders early, getting into that communication, meeting them on site, giving them all your comparables and all your data, to try and help them come to the sensible solution on your property. It has been in the last few months the most challenging part of the business. Thankfully, with these interest rates looking like they're coming down, that's why that one tick down, when we see that's going to make a huge difference, because those valuers suddenly will believe these kind of graphs that Kelsey's been showing us. They'll go, yeah, the market's on the down again. The worst has passed. I can be a bit more bullish, bit more comfortable with my predictions. But when it was going up to the tail end of the last year, very, very tricky time to get stuff refinanced. So we've just had to suffer really high mortgages on a few of our deals for a few months, which thankfully supported across the portfolio. But we've been destroyed on a few properties and lost money on them for a few months. But it's a long-term investment, and that's why they say with property you've always got to take a long-term view. And thankfully we have done on these, and we'll live to fight another day. But there would have been a few casualties at the tail end of last year for sure, and a few properties, and there'll still be more to come. But all part of the ups and downs of being a property investor and property developer. It's good fun. I think, unless anyone's got any other questions, has anybody other questions? I will wrap up. We've had a couple of latecomers, but that's no problem. The whole thing is recorded. We're going to be putting it out through our Wealth Labs. So log on to Wealth Labs, UK, and feel free to look us on there. We're going to put some of the content out on YouTube and bits and bobs like that, just to pick up on some of the salient points from Kelsey. And I hope it's been a useful webinar. We're going to do these every couple of months, just really looking forward to joining you guys on the next one, and seeing you again soon. And make sure you jump into Wealth Labs. We are here for these kind of things. There's lots of content recorded. We've got lots of new people coming on to do courses and presentations and webinars, positive mindset type stuff. I'm big on my positivity. This webinar and Wealth Labs, we are creating the Extraordinary Millionaire brand, which is the basis of a new book that I'm releasing in the next, hopefully, month. It's with the publishers at the moment, and series of books which are all based around mindset, and then the sub books like the Advanced Property Development book and the Property Strategies books. They're all based as subset technical books off the Extraordinary Millionaire brand. So that's a sort of sub brand we have within Wealth Lab. So if you guys see that knocking around, you'll know what I'm talking about. And yeah, pick up on some of the content. Hopefully it will help you guys. So yeah, look, it's been really nice seeing you guys today. Thank you very much, Kelsey, for joining us. And we'll see you on another webinar very soon. Take care for now. Take care.
Thank you, guys.
Thanks very much.
See you soon.
Cheers, guys. Bye.
Bye-bye.